Welcome back. InvestorX is back again with a new video. In this session, we're diving into one of the most essential yet overlooked principles of investing, diversification. You'll learn what it is, why it matters, and how to build a beginner-friendly diversified portfolio that balances growth with protection. So, what exactly is diversification? At its core, diversification means not putting all your eggs in one basket. It's a strategy where you spread your investments across different assets, sectors, and geographies to reduce risk. The idea is simple: when one part of your portfolio is down, another might be up, smoothing out your returns over time. For beginners, it's one of the best ways to protect against large losses without needing to predict the market perfectly. Let's say you invested everything into one tech stock. If that stock crashes 40%, your whole portfolio crashes 40%. Now imagine instead you held 25% tech, 25% healthcare, 25% bonds, 25% real estate. A crash in one area might only affect a quarter of your money. That's the power of diversification. It reduces volatility and preserves capital while still allowing room for growth. It won't make you rich overnight, but it will help you stay in the game long enough to build real wealth. Diversification starts with understanding the major asset classes you can invest in. Stocks, high growth, high risk. Ideal for long-term wealth building. Bonds, lower risk, steady income. Good for capital preservation and stability. Cash and cash equivalents, highly liquid, safe, but very low returns. Real estate offers rental income and inflation protection. Commodities includes gold, oil, etc. Often used as a hedge during inflation. ETFs and mutual funds, automatically diversified baskets of securities. International assets, exposure to global markets can reduce domestic risk. A diversified portfolio mixes these in a way that reflects your goals, risk tolerance, and time horizon. Every investment involves a risk-return trade-off. Typically, the higher the return potential, the higher the risk. Diversification helps you balance this trade-off. For example, a 100% stock portfolio might give you high returns but big drawdowns. Adding 20 to 30% bonds can reduce that volatility with only a slight dip in expected returns. The key is to align your portfolio with your risk tolerance. Are you okay seeing your portfolio drop 15% in a bear market? Or do you panic at a 5% loss? Know yourself first, then build your portfolio accordingly. Here are a few beginner-friendly portfolio templates. The 60-40 portfolio, 60% stocks, 40% bonds. A classic mix of growth and safety. The 3-fund portfolio, US stocks, international stocks, and bonds. Low cost, diversified, and easy to manage. The core satellite portfolio, 80% in index funds, 20% in active picks or thematic ETFs. The all-weather portfolio, inspired by Ray Dalio, it uses stocks, bonds, commodities, and gold to perform in all economic conditions. These structures can be adjusted depending on your age, risk appetite, and financial goals. Even with good intentions, many beginners make mistakes when trying to diversify. Over-diversification, owning too many funds or stocks that are highly correlated. More isn't always better. Ignoring correlation, thinking you're diversified with 10 tech stocks, they all move together. Set and forget mindset, building a portfolio and never adjusting it, even when your life circumstances change. Neglecting international exposure, limiting investments only to your home country can increase risk. Awareness of these traps helps you stay disciplined and make smarter allocation decisions. Over time, some assets will grow faster than others and throw off your target mix. That's where rebalancing comes in. Rebalancing is the act of realigning your portfolio back to its original allocation. For example, if your 60-40 portfolio becomes 70-30 due to stock gains, you might sell some stocks and buy more bonds. You can rebalance. By date, quarterly or annually. By threshold, when an asset class deviates by 5% or more. Automatically, some platforms offer auto-rebalancing. Rebalancing helps you lock in gains, control risk, and maintain your strategy. Here's an example of a balanced beginner portfolio. 40% US stocks. 20% international stocks. 30% bonds. 5% real estate funds and trusts. 5% gold or other hedge asset. This gives you growth through equities, stability from bonds, inflation protection via real estate and commodities, global diversification across regions. It's simple, low cost, and easy to maintain. You can build this with just 4 to 5 ETFs and adjust the weights as you learn more. Diversification is not a magic trick, it's risk management in action. You can't predict which asset will outperform next year. But with smart diversification, you don't need to. Your portfolio is designed to handle uncertainty with resilience. Start simple, stay consistent, and adjust as your financial goals evolve. In our next session, we'll explore how to track and manage your investments to stay on course. Thanks for watching, and remember, diversification isn't just wise, it's essential.